All right, ladies and gentlemen, I hope you had a wonderful day. We have Jerome Powell in the Fed tomorrow. I have your breakdown and what to expect, but I also have a big play that I want to talk about. So that's where we're going to start. And what you are looking at right here in green, that is the 2-year bond. And what you see in blue is obviously the S&P 500. But the thesis is very straightforward. And what I am expecting tomorrow is either bonds will rally with equities or they will do the opposite. You may have heard that before, but why this is so important for tomorrow, because after the CPI today, we are most likely not going to get a rate hike. And well, the last time bonds were crazy and all these, even the tops and bottoms, it had to do when the Fed paused in the past. So the first example is 2006. Remember, we were talking about May and June 2006. Well, take note, 2-year, it did the little 4%, 4.5%, broke out at 5 climb. But then after they paused, you saw the bond yields come down 1 year later, but the market was able to rally. So what does that mean? Following the 2006 pause, the 2-year note, the yields didn't go higher. And as the market got bullish, bonds eventually got bullish, and you see they were catching a bid as you were even going to the top, and then everything started to change. That was the 2006 pause. Now in 2000 or 1999, here is the other example, or what could possibly happen here. This is the market, and you'll notice the market went up the whole time, but they first did one light pause in 1999, and interest rates kept going up for a whole nother year. So what that means is that as people bought stocks, they were selling off bonds. And then in 2000, the pause eventually occurred in May of 2000. And then, well, everything came to an end, and then yields started to come down, and then you got all that. So based on what we got today, coming into a potential pause meeting and what is held, I think the 2-year note and the entire bond curve, they are at big levels. And we are going to watch something. Maybe it's its own new thing, but you guys know I like to bring up the history. So we're going to talk about that. That's the first thing. I hope you guys have liked the video so far. And if you don't know, we stream Jerome Powell live, press conference, analysis, all of that, youtube.com/the stock market. It's free 99. So that's it. But that's the first part. I hope you did all of that. Again, we're diving into it here on Fed Day, but now let's get to the rest of the keys and what to expect. I'm going to simplify it for you. We've said it a lot. Some people do not like this phrase, but what we are looking for tomorrow is called the hawkish skip. What does that mean? That we will not get a rate hike tomorrow. They end the 15 or 10 months in a row streak, but then Jerome Powell, the Fed, the FOMC, they make sure that they leave more rate hikes on the table, and they talk scary about it, or their financial projections show that they are serious and still committed and may raise rates again. That's why they are calling it a hawkish skip, because the minute you stop moving those rates, that's what I told you I was looking for last month. It's a very big deal, and the Fed seems like they're trying to communicate more, because a lot could happen, and I'm sure a lot of people are going to front run. Keep that in mind with the 2-year, but that's your first thing you got to understand. That encompasses all of it. But now, as far as what will be important tomorrow, we talked about this a little last time, but people are bringing it up again. Watch out for dissenting opinions. It'll show divergence on policy, especially if we are really going to see no rate hike at all. I'm sure 1 or 2 people may dissent, but that's what we were saying every other month, and you haven't seen it. But if you do see dissents, why I'm bringing this up here, and what we started with in 2005, 2006 leading into it, as they were ready to pause and change policy, you did see a couple of dissents. So I think over the last couple years, we really haven't seen it. So that one is going to be one of those wild cards. You see it or you don't, but even if it doesn't show up, I don't think it's going to have the biggest effect. But watch out for that. Another thing here in the essence of the whole hawkish skip, a big part about tomorrow is going to be that at the press conference, we should be expecting Powell to explain the skip and to talk about long and variable lags, and saying how we're taking our time to reassess it. We saw some good things, but there could still be more, in explaining how we're not done, the job's not done, and we don't want the market to do all of that. you should be expecting, and we should get an explanation from Powell on what it is, and that is what a lot of people will be watching out for. So keep that one in mind. Another thing for tomorrow, we've been bringing it up all week, but watch for questions on Canada and Australia, because remember, they had their little pause and raise fiasco. This is going to be important for Powell tomorrow, because they're going to say, wait, why are you any different than Australia or Canada? And what he'll probably say is, well, we raised a lot more aggressively and we did a lot more. I don't have a Powell voice yet, but that one is going to be big, but he could say something scary if he kind of takes a hawkish tone on that. And that's the thing. All of these factors I'm bringing up, however his tone is towards some of these factors, whether it's dissenting, whether it's the skip, Canada, Australia, any of that stuff, his tone will be key. Another thing, like I even got here, is even his tone towards sufficiently restrictive. I said here, if he defends that and his tone is still like, well, yeah, we did this, but we think rates are sufficiently restricted, even though there was a lot of base effects and inflation came down, we still think now, after all of the work we did, I like sufficiently restrictive, that will be bullish. But if his tone towards sufficiently restrictive kind of changes, that's what the market's not going to like. So these are the quick bullet points. I'll go over the final point, but we talked about this one on stream today. One thing to keep in mind, from the beginning of the year, Powell has taken on a much more different tone than anything you saw in 2022. Even the end of 2022, he was bringing out the stick, beating everything down. It's like we said, it's like when your parents, when you get old enough, you just stop getting your ass whooped. That's what it feels like, and that's why, too, just one element now, if the hawkish skip is expected, watch Powell's tone and let's see if he's any different halfway through the year. But those are what we're going to be looking for. Now, I got the real meat of the bones. I'm just giving you the quick bullet points, but really what it comes down to tomorrow, they are going to not raise rates, but it's not about that. What it is going to be about as far as reacting or getting anything to react to, I believe it is going to be the SEP, the summary of economic projections. This is going to be the next big thing, because this is how the Fed can communicate the next steps and a lot of other things outside of Powell. If they want to be hawkish and stop the market from front running or doing anything crazy, they could go about it by making sure that their projections are extremely hawkish, letting the world know that, hey, there's still a lot of a bumpy ride we expect. Now, here's the better part. Depending on how it comes out, it could also reflect some of the more improved sentiment. Depending on this SEP, if it doesn't change or other things reflect some of the new changes we've seen, that could also be good. So I'll show you what I'm talking about, but I do have specific numbers. So if you're not familiar, this is what the SEP looks like. It comes out every 3 months with the Fed. SEP, Summary of Economic Projections, and why it's important, because this is all of the Fed members kind of giving their idea on where they think GDP will be, unemployment, PCE, and then ultimately where they think the Fed funds rate will be. So right now it's at 5.1. We have reached it. That is the terminal rate. Now, here's the best part about tomorrow, and it also explains what is expected in terms of hawkish skip. All of the terminal rates across the board. You see 2023, 2024, 2025. These are expected to go up on every single one based on all the members. That's one thing you got to keep in mind. But now, here's the main thing and the simplest one. This number for 2023, it is also expected to go up, but I believe it's expected to come in around 5.3%, which is like 0.05 above the higher end of where we're at now, which is like basically or barely one more hike and can change. So we will watch this number move tomorrow, but this is what you got to be looking for. Pretty much any number higher than 5.5, which would take you into the realm above into 2 hikes, not just one, then I think that will be pretty bearish. So watch out for that number. But now another thing to keep in mind, given everything that's happened, the unemployment rate, this is actually expected to come down. Or if the Fed really believes that there is not going to be a recession anymore at this year, if the soft landing is really going to be reflected by the Fed, this unemployment rate for whether it's this year, 2024 and throughout, that should go down. And then as well, the GDP, it should be revised upward. So it's pretty cool to watch here, because what I'm trying to say is that the SEP, it is going to tell you how the Fed is thinking and what they really think. And the best part about it, this comes out before Powell even gets to speak. So we've had a lot of Fed activity around the SEP. It could give us a lot of insight, but this is pretty much what I'm going to be watching out for tomorrow. I think it will be very fascinating, but now let us talk about the play so we could get more into the bonds. But let us get into the play. So, right off the bat, obviously, the first play, the 2-year bond / ZT. We're going to go over this tomorrow. I don't know if I'm going to go big on it yet. I have a couple of ideas. I'm even going to work it in with some of those potential rollover plays, but you could play this in many ways. You can take the simple theme that I am sharing with you right now, whether we get the pause or if it's consistent or confirmed, depending on how it plays out, it's going to be either something like 06 or something like 01. The only way this like bond trade kind of fails or we don't see real big action around the 2-year is if we watch 2022 kind of be a hybrid between both of them. But what I'm saying here is that you could play the 2-year bond both ways. You don't have to have a thesis in the sense of, oh, I think it must go up, must go down. But what I'm saying here is that volatility around here and now the correlation with the stock market, it might be reaching that breakout point. So I'm leaning towards buy the 2-year, and the reason is pretty simple. One, I think if you get a pause, I don't know if the market can help itself to not try to front run it. Last time they did that in 2006, like I'm saying, right when they actually do stop, that means they're getting closer to it. And then again, just the language and everything from 2006, that's like the closest one we have. The bonds at least held the level. They eventually rallied, but the market was able to rally, and then bonds kind of held up, and then they eventually caught up. So if anything, I feel like it's a little bit better to go long on it, but like I'm saying, depending on what we get tomorrow, that could change things. But I am just trying to spot the relationship now between the SPY, the bonds, and the question is, can the market continue to rally if bond yields go higher? And if bond yields break out of 20-year levels, do they just stay there? And then what happens? Then leads it to everything else. It leads to everything else. But that's the first play. Watch out for that. Then play number 2. MPW. You're going to hear about this one a lot tomorrow. We are up 20% on the play from like 2 weeks ago that we shared. Remember, we bought the shares. We played the news. We even ended up buying the puts with the dividend. Well, guess what? You're up on it now, but tomorrow is ex-dividend date. So now tomorrow is when we could sell. If you sell out after the market bell, the market has to be open, and you are an owner of MPW, even if you sell out that day, you are entitled to receive the dividend when it pays out in a month. So like our strategy was, we use that dividend to buy the puts. So tomorrow at the opening bell, I might even wait a little bit depending on how it is, because like I'm saying here, even after ex-dividend, if that goes up, it's GG. But what I'm saying here is that I'm going to be selling out the trade shares tomorrow, and then my idea is hold the puts till Friday. If they expire worthless, then, well, we still get to walk away $2,500 net. So here's the play. After even losing on the puts, $2,500. Again, the puts are down, but you'll be compensated through the dividend. You're just going to walk away with $2,000. And then if we sell out tomorrow for a gain and then the puts somehow come to life, we might be able to double dip. It'll be an uphill battle, though, because this stock ran up a lot. Again, 20% underlying. Great trade, but watch out for that tomorrow. And then keep in mind, there will be a lot of volatility around a volatile dividend play around ex-dividend. So that is play number 2. And then finally, play number 3. This one's a random one. We have this one in the long term from a long time ago, but Overstock, they had news today that they're like the stalking horse bidder for some of the Bed Bath & Beyond assets. So maybe it gets some hype, especially if we get a pause and maybe ARK and other stuff go. I kind of like it there. I did like 200 shares. I'm going to try to flip it, though. So this one I'm not going to be holding there, longer term. And then as far as everything else, speaking of flip, I got out of my 3M trade shares, not my long-term shares. I got out of my NVIDIA. We were down on that a couple days ago, and then we were able to sell out of it, and then I was able to sell Intel from yesterday. They had the AMD AI thing, and I didn't want them to say anything that could make them eat their lunch. We had a good $500 profit or so I walked away with that, and then we made a day trade on like MPAA, and then I traded the 2-year bonds a couple of times today following the CPI, and that's it. And notice we barely even talked about the CPI because it all just confirmed what's going to happen tomorrow. But Chad, That is your watch list, ladies and gentlemen. Make sure hydrate, healthy, ready to go. Make sure you post your watch list. Make sure we see you there in the morning. I need the armor on. I need the helmet shining. I need you to remember to peel back the layers, explore the ideas, because confusion will leave you frustrated. So get to the bottom of it and be open to the ideas, because once you get to the layer, you'll realize it's not what you thought. It's probably not as bad as what you thought. That's word to Alley. You know what I'm saying? That's word to Mr. Watts. They don't feel me, Chad, but it's game time. Powell is tomorrow. You are ready for it. It's halfway through, Chad. I hope you feel the blessings, and let's keep it going and stay in the game. And that's all. Shout out the long term. I know you see it, so that's it. Am I doing the Trump hands? Oh, I tell you one thing right now. I have learned to do the Donald J. Trump is what I'm. Oh no, am I like this? Okay, I gotta go. Okay, I don't want this to be awkward. I'm leaving. I am going to leave, but when I am leaving, and then when I am gone, you can't say any. Okay, this is awkward. Just Hearn. Hit them with the Hearn.